Hello everyone, myself Jayant Mehta and I am the second year student of Design Equal College. Today I am presenting our topic corporate formation, governance and capital markets. This topic explains how companies are legally formed, how they governance ethically and how they raise long-term funds through the capital market. Meaning of the company. According to Companies Act 2013, a company is an incorporate legal entity. This means company has a separate legal identity from its owner. Some important features of a company are limited liabilities, perpetual succession, and separate legal existence. Because of these features, companies are consistently more reliable and stable from the business compared to sole proprietor or partnership. Steps of a company formation. This formation of a company involves several important steps. First, a business idea is promoted. Second, approval of a company name is taken from the Ministry of Corporate Affairs. After that, the memorandum of articles of association are prepared. Finally, documents are submitted to the registrar of companies, and once it gets approved, the certificate of incorporate is issued. And after these steps, the company became the legal entity. Corporate governance. Corporate governance refers to the system by which companies are directed and controlled. It ensures transparencies, accountabilities, and ethically decision making within the organization. Good corporate governance protects the interest of the stakeholders and shareholders. It also helps in building trust amongst the investors and approves the long-term performance of the company. Capital market. The capital market is a financial market where companies raise long-term funds. It acts as a link between the investors and the companies. There are two types of capital market. First, the primary market, where new securities like IPOs are issued. The secondary market, where existing securities are traded. In India, the capital market is regulated by SEBI. Type of a company. Under the Companies Act 2013, companies can be classified into different types. The main types are private limited companies, public limited companies, and a one person company, also known as OPC. Each type is formed from the different business needs and has different legal requirements. Real company example. For example, Infosys, PMP, Private Limited is a private limited company. Tata Consultancy Services or TCS is a public company listed on a stock exchange. One person company is generally owned and managed by a single entrepreneur and are suitable for the small businesses. All these companies follows the same act and the structures and scales of operations differ. Methods of raising capital. Companies raise capital through various methods. These include equity shares, preference shares, and debentures. Private limited companies raise capital from the promoters, public investors, and cannot issue shares from the public. Public limited companies raise capital from the general public, issue shares through the IPOs and stock exchanges. One person company. Companies are invested by a single owner. It is suitable for the small scale businesses. Conclusion. The conclusion companies' formations provide the legal existence to the businesses compared to the governance, insurance, ethical, and transparent management. And the capital market plays the virtual role in businesses, growth, and economic development. The Companies Act 2013 provides a strong legal framework for the smooth functioning of the company in India.